Good afternoon, everyone. It is my great pleasure to welcome you all and thank you to spend this wonderful Friday afternoon sunshine within this speaking hall. Welcome to Conversations about Europe. It is my great pleasure today to introduce to you Dr. Norbert Funke, who will deliver his lectures, and my role will be just to introduce him in a couple of words, and later on I will try to moderate your questions. Regarding the introduction, first about Dr. Funke, he is now director of JVI, Joint Vienna Institute. For those of you who may not be familiar, this is a very important institution, of course in Vienna. Needless to say, JVI was founded 20 years ago, 1992, I even remember when it was founded, jointly by 5 international institutions with a primarily role in training. In training officials from Central and Eastern Europe, Southeast Europe, as well as former countries from the former Soviet Union, because after the fall of the Berlin Wall, it was very soon understood that policymakers in those countries, to put it bluntly, don't know too much about how modern economic system functions. So basically what JVI did, together, Austrian government, IMF, EBRD, OECD, WTO, and I think European Commission, if I'm not mistaken, as an observer, okay, wow, no money, that means no money. They started organizing sessions, very specific policy sessions, and in those 20 years they managed to organize 1,100 of them, and roughly 30,000 people, just think there are about 1,000 people at this school, 30,000 people went to Vienna to get specific training on monetary policy, financial programming, whatever the fund does. So very, very important role. And a lot of those people are today working at central banks, working at finance ministries in all those countries, and hopefully taking better decisions than they would otherwise do. Another interesting point, which is linked to this lecture, is that when Joint Vienna Institute was formed, a little bit like EBRD, everybody thought that they have a defined shelf life. 10, 20 years after this time, their role will be finished, transition will be over, all those countries won't need neither the training nor the money from EBRD. Of course, little did they know, little did everyone know, that not only that JVI is alive, but I think demand for its services is growing. Enough about the institution, let me just refer very briefly to Dr. Funke, who, of course, as you may guess from his name, is a German national, but spent a lot of his career working internationally. He has been working at the private sector, commercial banking, at the beginning. After this, he was for a short period of time at McKinsey, OECD, if I'm not mistaken, as well. Spent more than 10 years at the IMF, working especially on African department, technical assistance to Africa, and as we all know, Africa is growing very rapidly today, one of the rare Asia parts of the world where growth rates are positive. So we may hear what he did right in Africa, that we may copy some of it here. After spending more than 10 years at the fund, he finally became director of Joint Vienna Institute in September last year, so he's been there for less than a year. And we are very pleased to have him here, and what I'm especially looking forward is listening to his lecture, which you can see is toward more sustainable post-crisis growth in Central and Eastern Europe, of course, and Southeast Europe as well. Working at a commercial bank now, I can tell you that it's not just the governments that are looking for a new growth model, but so are a lot of economic agents, including the banks. Simply the old model, as I'm sure Dr. Funke will explain, the whole idea of rapid convergence of our countries to an EU, to put it mildly, has been put under big question mark. So, not to take too much of your time, thank you for your attendance, and I leave the floor to you.
Professor Scrap, ladies and gentlemen, thank you very much for this very kind invitation and also for the very kind introduction. I think you explained Joint Vienna Institute better than I ever did. So I should invite you all back to come to Vienna, and also thank you very much for receiving me here and the kind hospitality I received so far from our colleagues. Today I would like to talk about the region, Central, Eastern, Southeastern Europe, and how we can achieve higher and more sustainable growth in the region. Let me start with giving you some of the main messages of my conversation. And then I'll walk you through it. Please interrupt me at any time, otherwise I'll try to make sure we also have time at the end for questions on issues you are interested in. So first of all, we have seen that many countries in the region have gone through a boom-bust cycle, but not all countries. There was very impressive growth prior to 2007, which was mostly driven by domestic demand and very, very strong capital inflows from Western countries. And we know now, and also at the time we had seen the vulnerabilities, that the growth model of the pre-crisis period was not sustainable. So then we'll look at the lessons of the pre-crisis period. So what went wrong? What do we need to take into account in the years ahead? And also, then I'll look more specifically at growth, including in Croatia. How much growth could one have expected, taking into account convergence? Which countries have done better than we would expect, and which countries didn't do as well? And what are some of the factors which explain why some countries have grown faster than others? And finally, I think the key point I would like to make is that in the period ahead, what is needed are more structural reforms. These take time to implement. It's a gradual process, but without more structural reforms, you will be likely really stuck in this relatively low growth environment. And key reforms are in the business area, in the labor market, and some other long-term challenges which need to be addressed, including pension and education. So these are the four issues I would like to address. First, the impact of the crisis on the region, the lessons of the crisis, then what is needed for more sustainable growth, and finally, what are some of the conclusions in light with the introduction of this? The global financial crisis, and I will not look back at all the wrinkles of the global financial crisis, but we have gone through various stages. It all started, as we know, in the United States with the mortgage debt crisis, which gradually built up and then came to a more or less full blow in 2007, 2008. The reason for the mortgage debt crisis were many reasons. We had a low interest rate environment. We had very optimistic market expectations. We had relatively loose sort of supervision of non-banks, and we had also issues related to moral hazard, because banks could just offload to asset-backed securities the mortgages we were taking on their balance sheet, so essentially not really bearing the risk of these mortgages. And then the banking crisis spread from the US to Europe. Many of the European banks, including public sector banks, were holding some of these mortgage-backed securities, asset-backed securities. So this is how the crisis spread over, leading to substantial problems in the banking sector here in Europe. On the one hand, requiring state intervention to help these banks. Also, the recession required to loosen fiscal policy and to stimulate demand. And together, these policies then led to a well-known increase of public sector debt in many European countries. So the mortgage debt crisis turned into a systemic banking crisis and then turned into a debt crisis in Europe. And now, I think we are facing all these political challenges. How should we move ahead in the euro area? What are the next steps, and how do we get out of the crisis? So what does it imply for countries like Croatia, for countries in your region? Looking at the pre-crisis growth rate, we see that countries in Central, Eastern, Southeastern Europe were among the fastest growing countries globally. only India and China were growing faster, but all other regions were growing slower. This high growth then also resulted in essentially the largest drop during the 2009 crisis period, much larger than in these other regions, which were partly because they were not so closely linked via trade and financial markets, were a bit more shielded. 2010 to 12, we had an initial recovery with some optimism, but since then, also in our projections for the next 3 to 4 years, growth remains relatively stable at a relatively low, unsatisfactory low level. So the question really is, what can we do to increase this? What is also important, that there is some heterogeneity in economic developments in the region. Starting with the country that has grown the fastest during the pre-crisis, Latvia, and also had the deepest decline, but Latvia is back to its pre-crisis level, and over a longer period from 2000 to 2013 has grown much faster than the other countries in the region. And let's look at another country case, Poland. What is remarkable with Poland is Poland essentially escaped the deep drop which we have seen in many other countries in the region. However, more recently, growth has been flattening out in Poland as well. But better pre-crisis policies in Poland, exchange rate flexibility and room to maneuver have helped the country not to be affected by that. For what is very interesting and very noteworthy is, you see for CESE countries, we had significant drop between 2008 and 2009. Croatia has grown very similar to the rest of the countries in the region, but since 2009, the growth in Croatia here is really sluggish or even negative. So that's sort of the gap has been growing to countries in the region. Questions: what is driving this gap? Still, these countries, Croatia and other countries, compare relatively favorably to Western European countries, which for the last 10 years really have been growing only marginally, and the crisis countries, what we call the CHIPS, Greece, Ireland, Iceland, Portugal, Spain, have been those most affected and essentially no growth compared to 2000. The highest concern I think we are facing right now is high unemployment. And unemployment above 15% is relatively common, including here in Croatia. In Spain, it's some 25%. And youth unemployment is really much higher still in these countries. So I think that's the biggest concern for the future, how to address these labor market issues. So that's, in a nutshell, what has happened since 2000. The question now is, what are the lessons of the crisis? What has gone wrong, and what do we need to do to improve the situation? First of all, some of the lessons of the crisis I'll explain in the coming charts are: we need to monitor very closely vulnerabilities, and I'll point to some vulnerabilities in the slides. Secondly, countries that had better pre-crisis policies, such as Poland, have not been affected in the same way, with the same magnitude, as countries which follow a much looser and less satisfactory economic policy. And then, good crisis management, so how you responded to the crisis once it's erupted, has helped to alleviate the drop, as well as, in some cases, financial support from the international community also has helped to reduce the impact of this very large shock. So what was the main issue? Underlying was what I said in the very beginning, that domestic demand has grown at unsustainable levels. If we talk about domestic demand, it's mainly consumption and investment. And so there were not a lot of exports. Most countries in the region had very, very large current account deficits. So you were importing capital mostly for consumption purposes and not for productive investments. So credits were used to invest in what we call the non-tradable sector, which creates a very large problem. How was this credit boom financed? It was mostly financed by capital coming in from abroad. Typically, we decide between portfolio investment, foreign direct investment, other investment. What is other investment? Other investments are typically investments from the banking sector. These are banking sector flows in your countries. In all your countries, you have a very important foreign presence of foreign banks. And so foreign banks and capital imports related to these banks mostly finance this credit. So what are now, so this was from the source here not a sustainable model in the long term. So what are some of the lessons we learned from the crisis for the period ahead? So first of all, private sector credit growth was unsustainably high in some countries. And of course we need to find the right balance. On the one hand, currently credit growth is extremely low. And it's the main question is how to stimulate credit and how to stimulate the economy. On the other hand, in the pre-crisis period, credit growth was very, very large. The lending standards were not necessarily always the best. And so you did create this unsustainable development. Secondly, part of the credit was used to buy assets. So you had enormous asset price inflation. For example, rising real estate prices in all countries in the region, more than 100% during a 5-year period is very, very extraordinary. Also, some of the vulnerability indicators were showing increased vulnerabilities during the pre-crisis period. What are some of the indicators we typically look at as economists? So first of all, we look at the level of international reserves. Why is the level of international reserves important? International reserves provide you insurance in case of a crisis. How much international reserves would one like to have? In the past, very often we looked at how large are your reserves in comparison to your inputs. And for a long time, the cover you were looking at was at least 3 months of inputs. So if there is any large shock happening, you do have enough for a short period of time to import the goods you actually need. With the globalization, other indicators have been added to assess the vulnerability in this area. And one of the indicators is how much reserves do you have related to your short-term debt, to your debt which is maturing within the next year. And to have a very comfortable cushion of international reserves, now typically the recommendation is to have 1 year of coverage of short-term debt. So even if your external financing is drying up, you would have enough reserves to cover your obligation in the year ahead. And you see that in most countries, including Croatia, we were below this 100%. Second indicator we are looking at now is the extent of foreign loans. And in many countries, the share of foreign loans, foreign currency loans, was relatively high. You could get relatively cheap credit abroad in foreign currency. Many of the exchange rates in the region were stable, kept stable for a long time. So there was not a perception of risk that there could be a depreciation of the exchange rate, which then in turn would increase the amount you need to repay to reimburse your loan. So now one of the indicators for recommendations is be really mindful and act with prudential and regulatory policy that the amount of foreign currency loan does not get too large in the economy. And thirdly, the indicator I already mentioned is very large current account deficits. So we have seen current account deficits above 10% of GDP, 20% of GDP. Current account deficit implies that you are importing capital, and similar to a private person. Whether this is good or bad really depends on what you do with the capital you are importing. If you are importing capital, using for productive investment, this is certainly something you would like to do. And this is also why less developed countries or emerging market economies, from an economic theory perspective, you would expect them to have a small current account deficit. However, if the money you're importing is mostly used for the non-tradable sector, for short-term consumption, in these cases, obviously this may not be a sustainable situation because you're building up debt abroad without increasing your productive capacity. So monitoring current account developments continues to be increasingly important. So there are also some macroeconomic policy lessons from the crisis. We know now that this boom period between 2003 and 2007 was not sustainable. What happened during this boom period? In parallel with very, very strong growth in the region, government revenues have increased very strongly. Real revenue growth fluctuated between 40 and over 100% during the 2003 to 2008 period. At the same time, debt in the region was relatively low, so there was not the feeling we do need to save part of these revenues which are related to the extraordinary boom period. And therefore, expenditure growth was similarly large, implying that when the crisis hit, there was no real buffer to respond with an anti-cyclical fiscal policy to cushion the impact of the crisis. So whenever you are in a boom period, you should not only look at the fiscal deficit, but you need to adjust it by taking into account general economic developments. You need to look at structural deficits to get a better assessment of the actual fiscal policy situation. During the crisis, what has happened? All countries have seen an increase in the fiscal deficit, which also, together with a decline in growth, translated to a gradual increase in the debt to GDP ratio. So here the 60% Maastricht criteria for debt to GDP is this dark blue circle. At the beginning, prior to the crisis in 2007, most countries with relatively low debt to GDP level. And as they responded to the crisis, debt was gradually increasing. And now in some countries, including, for example, in Hungary, in Macedonia, we are already above the Maastricht level of 60% of GDP. And Croatia is also getting very close to this level. For smaller emerging market economies, some research suggests that even 60% is a level which makes you very, very vulnerable. Some research says 40% could be considered as a maximum desirable level of debt. There are also some financial policy lessons from the crisis. First of all, we need to focus on supervisory practices. I think the laws and regulations, in many cases, the banks have been in place. What has not worked so well is what we call the home host cooperation between supervisory authorities. Home host cooperation would imply, say you have an Austrian bank here, Raiffeisen, or any other bank here in Croatia. And if the sharing of information. If there is any issue in the banking sector, you need to fully cooperate with the country where the mother of that bank is being located. A lot of progress has been made since. There was also the so-called Vienna Initiative to help improve the cooperation in the region, but that's clearly one of the key lessons in the financial area. Secondly, what I said before, monitor credit growth carefully. Currently we are in a different situation. The question is how we stimulate the economy, but at that time credit growth was too strong. And also be very mindful of foreign currency lending, which can lead to very difficult and challenging balance sheets effect if the currency comes under pressure and currency depreciates. Another factor which has helped in the crisis is a lot of international support. There are quite a few programs supported by the International Monetary Fund, and there are also now well-known programs of the Troika, where the ECB, the Commission, and the International Monetary Fund are working together. And you see that most of the countries in the region, at some stage in the last few years, had an IMF supporting program. The type of programs the IMF offers differ depending on the type of a country. If it's a low-income country, you get what we call a concessional loan, where the interest rates are extremely low. Currently they are zero. And the types of programs also differ depending on the underlying issue you want to address, whether it's more a short-term liquidity issue or whether it's a longer-term protected problem. And therefore, what we see here, these are the different types of programs. Standby arrangements, extended credit facility, extended fund facility. Flexible credit line has been used by Poland very effectively. Flexible credit line is in principle like a credit line in your bank. Given your relatively strong policies, the IMF board approves a credit line on which you can draw when you actually need it, without sort of any additional conditionality. So these are some of the lessons of the past, some of the policies we should look at in any moon period going forward. But obviously right now we are in a very different situation. Growth is extremely low, stagnating at a low level. So the question is, what kind of reforms are really needed to help us get out of this very difficult. The following analysis I present you does the following. We look at growth rates in Central, Eastern, Southeastern European countries, and at growth rates we would have expected under simple economic growth theory, which says that countries with a lower real GDP per capita, so countries which are less developed, should grow faster. And all this comes under terminology of convergence. So you would expect low-income countries, all other things being equal, to grow faster than higher developed countries. So what we do in this analysis is we look at the situation of countries in 1999, 2000, at their income level at that time, and then sort of estimate, just based on the convergence on growth theory, how fast should they have been growing since then, and then compare it with the actual growth, and we'll see that some countries have been growing faster and would have been predicted by convergence, and some countries have been growing a little slower. And then we look at what could possibly explain this difference in the growth patterns. The findings, I think, are somewhat sensitive to the observation period, to the choice of countries we include in such an analysis. Nonetheless, I think we experimented with different periods, including some countries, excluding some countries. I think directionally, they clearly point you to relatively strong policy. So first of all, what I said before, let's see whether poorer countries really have grown faster. And the answer is yes. What we show here on the x-axis is GDP per capita, so how rich have countries been in 1999 in logarithmic terms, but meaning countries which are further to the left have been poorer in 1999 than countries which are further to the right. And you can see this is true. All the Western European countries already had a very high GDP per capita at the beginning of the century. And some of the Southeastern European countries or Central Eastern European countries had a much lower GDP per capita. So the first observation is, said before, countries which were poorer, on average, have grown faster than countries which were richer. So all West European countries are red, all others are blue, and Croatia is marked separately for Europe. So what we already can see here, and I'll come back to this result, would suggest that countries above this line have grown in the sample faster than what you would expect is attributable to convergence. Countries below this line have grown less. So where is Croatia? Croatia is relatively close to the line. It has grown a little less, as one could have predicted within the sample in terms of convergence. Economic theory, also simple solo growth model, would predict that the driving force for higher growth is higher investment. And again, you see this is very well true here in our sample, that countries which were poorer also invested more. So now, in the rest of the analysis, let's say an important concept, I will look at what I call growth beyond convergence. And in the following, I will also call it adjusted growth. Growth beyond convergence implies how much has a country grown either faster or slower than economic theory and the sample would have predicted simply based on the initial stage of development in 1999 and 2000. So, and what we can see in this sample, what we can see is countries which have grown faster than predicted by convergence include Serbia, Latvia, Estonia, Romania, and Lithuania. Countries which have grown much less than predicted by convergence include Macedonia, Bosnia, Turkey, Albania, Slovenia, but also, I think Croatia is very, very close to Turkey. In the sample, it's just. I think for the future, obviously, it would be interesting to know what did the countries which have grown faster, which have managed to grow faster than we would have predicted, what have they done differently, or what are some of the policies which could have been different? So first of all, there has been recently a lot of discussion in Europe on the role of public debt, and there's a lot of discussion on austerity versus growth, which I think is a false discussion. But at the same time, here the analysis would suggest that countries which had a lower debt level tended to grow faster. So reinforcing the point that good macroeconomic policies tend to pay off and are conducive to higher growth. So what you see here and in all the following charts is on the y-axis the adjusted change in real GDP per capita. So it's a change in real GDP per capita above or below what convergence could have predicted, compared to a number of factors which we'll always have on the x-axis. So what are the factors we are looking at? So debt was the first one. The second one is trade integration. So how much more trade have you generated in terms of GDP between 2000 and 2012? And you see that countries which have been more successful in increasing their trade have also seen higher adjusted growth. So trade integration, I think, is really important, and potentially also for Croatia, after the session, possibly one of the points where one could hope, together with institutional reforms, that you can realize additional gains. Very importantly is also labor market efficiency. And labor market efficiency, I think, is a broad term, but it implies how easy is it to adjust to changes in economic development. Is the labor market flexible enough that workers can change jobs if there are changes in the structure of the economy? Are there, the wage rate very, very high? Are there minimum wage rates which are above the market here and there? So these are things which matter in labor market flexibility. And again, the results seem very striking that countries which had more flexible labor markets also have seen higher adjustment. The next one we are looking at is the ease of doing business. And ease of doing business, again, is one of these composite indicators here from the World Bank, which is how easy is it to do business in a country, how easy is it to set up a business, how easy is it to get construction permits, and so on, in this composite indicator. Again, very, very strongly, and this here is that's the ranking, so we have 150 or 160 countries which have been ranked according to their doing of business. And countries with rank 1, 2, 3, 4 are those who are better in terms of doing business, and the others are performing as well. So again, you see countries which have been doing better in terms of doing business also have seen higher adjustment. Another variable which matters a lot is the quality of education. And one of the variables we here look at is tertiary education, how many students are enrolled. Again, the message is countries which have better education system, where education is stronger, tend to have higher adjustment growth. So, trying to put these pieces together, I think we have identified a number of areas which matter to be able to grow beyond convergence. If you look at composite indicators of competitiveness, again, which almost rank many of the things we discussed about individually, which put them together and say how good are countries doing, you see that the fundamental problem in Central, Eastern, and Southeastern European countries is that competitiveness needs to be improved. On global competitiveness ranking, Croatia, the World Economic Forum ranking, Croatia is number 76 in terms of institution quality. How easy is it to lose the laws and so on? It's number 52. And in labor market efficiency, very striking, it's only number 116. So these are really areas where we think it would be very important for countries in the region to make progress in inclusive.
Wait, in the labor market efficiency ranking, the higher number is the worse?
Yeah, it's the ranking. Okay. So number 1 would be the country which has the most efficient labor market. So many countries, including here in Croatia, have started to put in place structural reforms. I think this is, as I've shown before, in our view, really very important. Reforms are needed in a number of areas, in business climate, education, job training, and also in critical infrastructure projects to facilitate trade. Long-term challenges also need to be addressed, and we haven't touched on them, but pension issues would certainly be one. So what does this all leave us? Are there any benefits to come? And I'm very curious later on to hear your views, what you are expecting now from EU accession. I think on one hand one can argue that a lot of potential benefits have already been taken up, so there may not be, one may argue there may not be such a big change as of this summer with full accession. On the other hand, one could also argue that I think it can provide still a very strong signal to the international community, together with structural reforms which need to be implemented anyway. I think it does create additional opportunities for Croatia. It depends on the country whether you will benefit from it. You need to put in place some of these institutional, all of these institutional structural reforms we just talked about. So is there? Let me look again at the chart. We look here at adjusted growth again. So how much have various subgroups grown beyond what we would expect from convergence? And Central, East and Southeastern European countries, excluding the new member states. The new member states here are countries which accessed the European Union either in 2004 or later, have grown less than we would expect from convergence. Croatia, as we have seen before, also has grown a little less. The new member states have grown faster than expected by convergence. So I'm not going that far when I suggest that you become a new member and automatically you will grow faster. But there may be something here to suggest that, at least historically, these countries have done well and used partly also the opportunity by accession. However, another chart which I just would like to put up for discussion, for comments, what we've also seen during the past few years, and I think that's almost a fundamental question, is that countries which have grown faster also had larger volatility in real growth. So the countries which have grown fast on average are also those which had larger boom bust cycles. So the question is, and I just pour it out as a question, what your view is, essentially an unpleasant side effect of the higher growth has also been the larger vulnerability to external shocks. Larger financial and trade integration at the same time has made you a little more vulnerable to external shocks. That's the question. Let me conclude, so we have some time for discussion. In the aftermath of the crisis, the initial task was really to stabilize the situation, to ensure that there would not be a complete meltdown. And I think countries have been very successful in that regard, although the adjustment costs are very, very significant. The initial vulnerabilities which were needed to be addressed were both in financial, very particularly in the financial area. Despite a lot of progress during the past few years, some vulnerabilities remain. Some of the vulnerabilities are that public finances are not yet as we would like to have them. So we have seen that debt levels have gradually increased and maybe close to levels which may not be sustainable in the medium term. Also in the banking sector, non-performing loans have gradually increased, and there's been a lot of demand for higher equity cushions as well as higher provisions for these non-performing loans. And foreign currency lending, external debt still are issues. So we're clearly not yet fully aftermath of the crisis. So what is needed next? I think this presentation I would like to argue that the lack of sustained growth is partly due to the weak external environment. You are closely integrated with Western Europe, and the lack of demand in Western Europe clearly has a negative impact on Croatia and other countries in the region. But it's also, there were flaws in the pre-crisis model, and there is an issue that on your structural reform agenda, countries are not moving ahead fast enough. And to bring back growth to a higher level, to make it more sustainable, and to try to minimize the risk in the future in bust cycles, this is a key area. Several structural reform areas are important in this respect. We have labor markets, I think an extremely important area, trade integration, the business climate, and more generally, let's call it institutional reforms. Reforms in these areas will help you to get substantial time, to increase income significantly. At the same time, I think we need to acknowledge that reforms will make a difference. They take time to implement, and we cannot expect, sort of in the short run, any large gains. But over a 10-year period, I think gains can really be significant. And with this, I'd like to thank you very much and open up to your questions. For those just interested, it's not for you, we can circulate sort of something in the joint guidance.
Okay, first of all, I would like to thank Dr. Funke. We already had a round of applause for this very interesting lecture, all round, starting from the causes of the crisis, what are the recommendations, and I leave floor now entirely to you, asking questions. What do you think about this? You are the ones who will spend the rest of your life in EU, most of you at least, not foreign students. So I think you have a good opportunity to try to get the answer. So please, who will start first? Yes. Please, maybe, well, we all know Martin, but what I would recommend is that you introduce yourself so that we know whom we are talking to. Please.
So my question is, you mentioned that you think that the debate austerity versus growth is a false one. So could you please elaborate on that one a little bit more? If that's the false one, which debate should we be having?
Maybe if I may suggest that there are other questions, similar questions to combine them. So if not, we can start with that. No? Okay.
You can start. I think it's a false debate because it's not austerity versus growth. You know, if you frame it like this, it sounds as if you have only two options. Either you have a very strong fiscal consolidation, or you don't get anything. I think to me, the right question would be, what do you need to do to increase growth over time and in a sustainable manner? In the answer to this question, you obviously will need to think about what the appropriate speed of fiscal consolidation is, what the link between debt level and growth would be. And here I would suggest that many countries have reached debt levels which are not sustainable in the medium term. We are on dynamics where we clearly need to reduce debt relative to GDP from current levels. The question is, how quickly can and should we do this? I think there has been some acknowledgement at the European level that in some countries debt reduction may be advisable to go a little slower than we had in mind a had in mind initially. Partly because of academic research, which has been going on, which showed what we call a fiscal multiplier. So, what is the impact of one additional unit of fiscal spending or one additional unit of fiscal restraint on economic development? But the fiscal multiplier in the current situation is larger than what we had expected. On the other hand, there are also countries where debt levels are so high, you can't really risk of going higher, because currently financial markets seem to be relatively complacent, but shifting market sentiment could really otherwise create new challenges in this country.
Thank you. Questions? Yes.
In terms of the book, which I'm also lecturing here in school, in terms of financial lessons from the crisis, from the supervisory perspective, how would you comment on the Basel standards? Could we consider them as a regulatory failure as well, in a sense that they, for example, increase artificial demand for sovereign debt by reducing the capital standards for buying sovereign debt, as opposed to, for example, corporate debts? The same thing happening, for example, in the United States with MBSs. And is that perhaps another regulatory failure that should be addressed, and in what way?
Just as a follow-up to this question, it's quite similar. And now some people, as we know, there were countries within the Eurozone that, to put it mildly, failed. Okay? And I'm now deliberately provocative. Some addressed this to the policy of ECB in their monetary policy to basically take in repo government papers at the same value. So there was no risk differential, let's say, between Greek papers and other papers. So for the private market, it was the same. They were buying Greek bonds, knowing they could refinance them with ECB. Okay, I know the official ECB answer, but just to add some spice to these risk differentials.
Okay, these are very good, good question. I would still think that the largest challenge was the regular system is being reviewed. So Basel III is sort of supposed to address the issues which were identified in Basel II. But I think the larger question really is at the time were the issues in the non-bank and shadow banking sector in the United States, which were not regulated and which created a lot of opportunities for these institutions. On the question of the ECB, I think there's a lot of debate on the appropriate monetary policy and how to respond to the crisis. I think the quantitative easing we have seen now also in Europe was at the end of the day a game changer. Last year in 2012, we were relatively close to some market participants thinking that the euro would not be able to stick together. And the game changer then came, essentially, as Mr. Draghi said, we'll do whatever it takes to save the euro. The question is, for us going forward, how do we, while the accommodative monetary policy, I think, clearly has helped to address the issues of the crisis. The question is, how will the unwinding of the accommodative monetary policy work? How will we get out? And there's also a large debate on rethinking macroeconomics. Is everything we were lecturing until maybe 2007 that there is a stable relationship between money supply and inflation, and that you need to be very mindful that you should not finance government deficits, that you should not intervene. Is all of this no longer valid? Or are we really in a new area, or are we just in a transition period, and we will need to go back to to more conventional measures going forward. I think this debate is ongoing. Personally, I think I don't see forever monetary policy pursuing non-conventional measures. At some stage, we will need to.
Okay. Questions? I have another question, so if you think you will immediately you are wrong.
This question also difficult.
First, I have a suggestion to the school, maybe when we have lectures in the afternoon, and especially in this room, we should have free coffee. I mean, it's superior, so
There should be free coffee.
Okay. No, my question is more related, I think it's not so difficult, more to the lecture that you delivered. And it's about convergence. We have seen that there was a relatively high differential between growth rates in Central and Eastern Europe and new member states and so on, and the advanced economies of Europe. So, for our countries, joining EU has always been, if you want in one way, a beacon, and especially a model for faster growth. If I'm not mistaken, there is even a World Bank study which shows that EU is the most efficient convergence machine ever devised in history, in terms of turning countries to higher growth paths. Now, with this crisis, my question is, do you think this is still valid, and to what extent is it valid?
Another very excellent and open question. I personally think that Europe has two choices at this stage. One is to really move ahead fast. That's my preferred option with European integration. If I say this, we need a banking union, we need a fiscal union, and we really need to think about some kind of central fiscal power at the European level. More integrated Europe, I think, will give us tremendous new opportunities, and I'm sure the old model will help new member countries to catch up faster, but still hold. I think what is difficult is the current slow progress. One does observe a bit that if markets put countries under pressure, a lot of reforms happen both in the country and at the European level. But as soon as market pressure is a little less, you also see that reform momentum starts to decline, and that's obviously dangerous. Coming back to your question, I think clearly I would say Europe is still a tremendous opportunity for new member states, and I hope if we all work together on it, there should be a bright future.
Thank you.
Yes, hi. I'm Milo Starovic. I work for Barclays Emerging Market Desk in London, and I'm guest speaker at the London School of Economics. I wanted to ask which parameters did you use when assessing the efficiency of the labor market, because Croatia is ranked pretty clearly in the 112th place or 116th place, I believe. I found a bit, how would I say, surprising result in comparison to some other countries from the region where I was expecting more disastrous results, such as Montenegro and other I would say, yeah, well, that's outside the question, but my other question is also when we talk about the need for the more balanced growth and the success of European Union as a project. I mean, myself, I'm a great supporter of the integration as a whole, but what we will have now is we will have 28 countries, members of the European Union, as a supranational organization. However, don't you agree that we have such a huge disintegration when it comes to regional? We don't have we have still a very low degree of regional integration. So if you think about the countries that are neighboring each other, that are either members or even still not members of the European Union, we have such a big discrepancy and low degree of regionalization, while we have at a supranational level, we tend to have high degree of international integration, right?
Well, First of all, on your labor market question, we have used the labor market efficiency index from the World Economic Forum, which is published in the Global Competitiveness Report. And there are different labor market indices. The World Bank, I think, also in their doing business indicator series has one. The underlying finding is robust. The situation of the country's specific situation may differ a little bit according to the indicator. Yes, I agree. We'll have 28 countries with tremendous opportunities, but also with a lot of regional disparities. We had already a lot of regional disparities within countries, Germany, East, West, Italy, North, South. And now bringing all this together, regional disparities maybe even at least as large. We also see in academic research that, for example, with regard to labor mobility and culture and different languages are still a hurdle. I mean, we are gradually overcoming that hurdle by you following courses here in English, we are teaching in English, so that's clearly being reduced. But for the less skilled labor level, these are still hurdles which I think gradually will need to overcome.
Further questions? Well, if not, I would like again to thank you very much, Dr. Funke, and maybe we should invite in a couple of years from now some of you to join jointly an institute in the period. So thank you so much for the time.
Thank you very much for the invitation, and thank you for all your questions.